Welcome to another one of Professor Karn's accounting videos. The purpose of this video is to discuss capital investment decisions and how corporations need to use this analysis when they invest in large projects. Alright, so let's talk about as far as what is capital budgeting. When you think about it, we have several terms to define here. When you think of a capital asset or plant asset, that's an asset they're going to use for a long period of time, specifically in operations. When we think of capital investment, that's how we have to go out and acquire a capital asset. And the process that we use to plan and how to invest in these long-term assets that really returns hopefully the most profitability to the company, that's the capital budgeting process. So as we move forward here, we need to look at different ways to analyze capital investments. And the four ways that we're going to do this for this particular video and discuss are payback period, accounting rate of return or ARR, net present value NPV, and internal rate of return IRR. So one thing we have to mention before we look at all of these things are really the emphasis on cash flows. Remember GAAP, or generally accepted accounting principles, that we follow in financial accounting, those are based upon accrual-based accounting. When you think of, it doesn't matter when the cash is received, it matters when the revenue is earned or the expense is incurred. It doesn't matter when the cash comes in or goes out. Capital budgeting, on the other hand, focuses on cash flows. So if you look at the inflows versus the outflows of cash, think of inflows of cash, revenue generated from the investment, savings in operating costs, or residual value, anything that we deem that we think that the capital asset will be worth when we've done depreciating it. And then cash outflows, things, money going out when you think of the initial investment, what it costs to acquire the asset, additional operating costs, and any refurbishment, repairs, and maintenance that has to be done on the asset. So you can see the life cycle of the capital investments here. You can see that they start at the acquisition, and the initial investment and outflow occurs at the time the asset is purchased. And then during the usage of the asset, obviously you're going to have revenues generated, the inflows. You're probably going to have operating costs incurred for the asset, outflows, and also potentially refurbishment, repairs, and maintenance, which would be outflows as well. Now when you go to dispose of the asset, you could have the residual value, if there is one, which would result in an inflow at that time when you dispose of the asset. So we look at the first two methods we're going to analyze. We have payback period and accounting rate of return. When you think of these types of investments, you would want to look at the shorter ones to use these analysis for. And the reason is, and you'll see this in a little while, is that these two methods do not really take into account any present or future value of money. So the time value of money aspect. So these would be good for shorter capital investment analysis. So we talk about payback, and you also hear it referred to as payback period. Really all that is how long does it take to recover in net cash inflows the cost of the initial investment. So if you look at this, you can see we have a specific formula. So what we're going to look at is we're going to take the amount invested, and we're going to divide that by the expected annual net cash inflows. So what we're going to look at here as an answer is you're going to get a time period, the number of years. So what we want to look at from a decision perspective is, when you think of a decision rule, is that you want investments with the shortest amount of payback period because that is going to yield to you the quickest amount of time your initial investment is returned to you, and then hopefully more revenue generated as you move forward. Now, you have to be careful there. You want to make sure that you're comparing everything being equal when you think of the projects that you're looking at. So make sure that if the project is, say, useful life is 6 years, they make sure that the projects that you're getting bids on would be all 6 years, so you can see what would be the shortest payback period. When we think of accounting rate of return, this is going to be basically a way to measure the profitability of the investment, and we have a specific formula for this. That is the average annual operating income divided by the average amount invested. Now, this gets a little bit complicated because we really have to use a pretty extensive formula to determine the average annual operating income. And this is what we would do. We would start off with taking the total net cash inflows during the operating life of the asset. That's variable A. We would subtract out the depreciable base or depreciable cost, which is our cost minus residual value, and that's the total depreciation during the operating life of the asset, which would be variable B. And once we subtract A minus B, we would get the total operating income during the operating life of the asset. We would simply then divide by the asset's operating life in years to get our average annual operating income from the asset. I would really caution you when you're doing problems like these and analysis like these to really carefully maybe type this up in Excel so that you can use it, this formula very easily, and it will just calculate it all out for you when you enter the data in. So our decision rule for accounting rate of return, obviously the business is probably going to have a desired rate of return for the investment. So if the ARR meets or exceeds the required rate of return, you would invest in that project. And if the ARR is less than the required or desired rate of return, you would not invest in the project. So we talk about time value of money now because we're going to get to the final two types of analysis that we can do. We talk about net present value and internal rate of return. And remember back, you may have seen in other chapters, when you think about bonds, you have to use present value tables. You want to think about how $1 today is worth more than $1 to be received in the future. So you think about interest over time, and we really have to be wary of that when we think of incorporating this into our analysis to give us a better estimate of what we think the rate of return will be. So let's look at each of these. When you think of principal amount, you think of P. So you want to think about, you could have a situation where principal could be a lump sum or an annuity, which is a certain amount of payments over a certain period of time. You have the number of periods N, and again, that's the length of time from the beginning of the investment until it is terminated or completed. And you have your interest rate, the annual percentage interest rate that is earned on the investment. So we think about, again, payback or accounting rate of return. Neither of those recognizes the time value of money. So for larger investments and longer ones, you would probably want to try to incorporate your net present value analysis and internal rate of return analysis to determine the actual rate of return for the investment. So net present value simply is going to do basically one calculation. You may have to do two if there is a residual value, but we can check on that in a little while. When you think of what you want to do, you're going to take the present value of the investment's net cash inflows, and you're going to subtract the investment's initial cost, and the difference will be either positive or negative. If, and we'll see this in a decision rule in a moment, we'll reinforce this, if your net present value is a positive number, greater than 0, then your investment is exceeding what is called the discount rate, and that is the management's minimum desired rate of return on a capital investment. If your net present value is less than 0, that means the investment is not meeting the discount rate or the desired rate of return on the capital investment. So you would potentially invest in anything that had a net present value of greater than 0, and you would not invest in something that had a net present value less than 0. And you can see this here on the decision rule tree. Again, if NPV is positive, you would invest. If the NPV is negative, you would not invest. Now, what is internal? Well, we'll go to profitability index here first. When you think of profitability index, this is something else that you could look at here as far as simply taking the present value and of the net cash flows and dividing by the initial investment. And the higher, the better here. You want a higher profitability index, and you could use this particular measure to determine which would be a greater profitability return. So if you had you're looking over two projects, you could look at this as something that hopefully would be the higher the better there. So internal rate of return, again, when you think about this here, this is where your net present value of the investment is equal to zero. So what you're going to be able to do is you're going to be able to use your present value tables to help determine a range of where the net present value would be equal to zero, and that would be exactly the internal rate of return of the project. So let's say your net present value comes out to be $450,000. Well, that's going to drastically exceed the percentage of return that you were looking for, but we can still estimate that using the internal rate of return, using present value tables to determine what your actual interest rate would be. So, if your IRR meets or exceeds the required rate of return, you would invest. And if your IRR is less than the required rate of return, you would not invest. Okay, so thank you again to Pearson Higher Education for allowing me to adapt their PowerPoints to use in my videos for educational purposes. You probably want to check out the problems on these. Be sure to take your time. If you have any questions, please let me know.